Hi everyone and welcome to Symax Fintech's weekly market insights. As usual, let's just get past the disclaimer. So trading involves the potential risk of loss of capital and is not suitable for everyone, but yes, I hope it is for you. As some companies provide leverage, just be a little bit careful of that. You can lose substantially more than that initial investment. The views, opinions, everything contained in this is just solely for educational purposes. We're just trying to help set you up for the week ahead. And of course, it does not constitute investment advice, or we are not encouraging you to trade or invest. That has to be your decision. You should carefully consider the risks involved, your financial situation, definitely your level of experience and your risk appetite. And of course, you should only risk capital you're prepared, but more importantly, you can afford to lose. Don't risk too much of your capital. Any doubts whatsoever, seek independent financial advice before you risk that capital. Make sure you know what you're doing. Understand trading, understand the markets. We're here to help you with all that. We provide courses in all different types to help people. Even if you're doing one of these competitions, you want to get you haven't got the capital yourself, so you want to get that capital funded account, they call them. So if you want that, then again, we provide a preparation course to help you get ready for them. So, reach out to us. We'll certainly help you. Our contact details are on the last page. Okay, so here we go. Highlights of last week. So, earnings continued to be mixed. Tech shares dumped. When you look at the value, absolute billions wiped off of their shares in the last weeks. Meta dropped big 20%, and it also dropped out of the top 20 stocks as well. And of course, these earning reports are mixed because you've got banks and energy companies that are performing well, but the tech shares just are disappointing. The dollar. So the dollar weakened a little bit. Now, when we look at that, that is, for me, it's with expectations that the Fed's going to slow down their rate rises and that they're perhaps coming towards a close. Personally, I'm not so sure. They're going to want to see inflation down and stay there. So even if they stop raising them, they're not going to drop them again. They're going to leave them up there for probably 3-6 months at least to sort of have the confidence that they've beaten inflation. And of course, as we know, and we keep talking about it, they can try and control the demand factor, but they haven't got any control over the supply side. So Musk finally bought Twitter, and of course the first thing he did was get rid of some of its execs. And I think that he will trim down the numbers a lot more than he has already. And of course he's also planning to revoke the bans, these lifetime bans that were given on certain people, including Trump. So maybe he'll actually come back on and start tweeting again. We'll have to wait and see on that one. But it will be interesting if Trump comes back, especially, of course, with the midterm elections round the corner. ECB raised their rates 75 basis points. So they doubled the rates, basically. And, from what they're saying, we've still got to expect more. So their rates at the moment still, behind most, but 1.5%. Refinancing's at 2%. When you think they was at negative 0.5, I mean, at least now they're back into that positive territory, which is great. And of course, Japan hasn't done that. Japan is still negative. It refuses to join the band. It's left its rate unchanged at negative 0.1 and adding more stimulus. And that is despite the fact that their inflation is creeping higher. It's now up to around about 3.5%. Now, Canada, again, surprised because they only actually increased by 50 basis points. That puts their rate at 3.75 now. And of course, you know, they want to wait and see. They're expecting that the rate hikes that they've put into the system will start to take effect. And you know, now they just want to hold back. They don't want to be quite so aggressive for the moment. Sunak, our new UK PM, you know, they pushed the budget back to mid-November because they've got to find about 50 billion from somewhere, and that's going to be potentially from tax increases as well as spending cuts. But you know, you can expect austerity in the UK, which is not going to be helpful when there's a lot of pain already being on the low and middle earners. You know, with high food prices, high energy prices. It's, you know, recession's around the corner for sure. Okay, so US GDP was positive, so it takes them out of that technical recession that they was in. Now, US PCE came out, and that was, you know, it just stays sticky. You know, it's one of the key metrics for the Fed, and you know, it's not coming down. So again, don't expect the Fed to slow down these rate increases as fast as possibly some investors are now expecting. And you've seen that this week because the stocks had a bump on the upside. And you know, that was even despite the fact that manufacturing PMIs were low everywhere, you know, in pretty much all the countries, Europe as well as the US. Consumer confidence is still weak. In the US, it's stronger, of course. Now, you know, we are coming up to the US midterm elections, 8th of November. Just make a note of that. And it will be interesting. I'm actually doing a sort of a chat show webinar in the evening of that day with some guys in the States from Ninja Trader. Okay, and then China data improved, although retail sales was lower, and you can expect that to continue for the moment with these lockdowns. And you know, they seem to be coming more rather than less. And just a little bit of a reminder, the clocks changed in Europe and the UK this weekend. We went back an hour, and so that's, if you know, if you're in Europe or the UK, that is going to impact the times that all of the US data comes out for the next week. The US do their clocks next weekend, so it's only for 1 week. Okay, so moving on to this week. First of all, happy Halloween. Have a great time. Again, you know, it's a fun time, celebration. So some countries are bigger into it than others, but you know, it's great for the kids for sure. We're going to see more more Q3 earnings, well, UK as well, but everywhere. And it'd be interesting to see how they continue. So that extra hour in bed, just to remind you, it's the US next weekend. So the US data is going to be an hour earlier this week. So, you know, just remember that if you're in Europe. So US, we've got manufacturing data. You know, that's going to provide an insight into consumer demand. Now, ADP, I don't usually worry too much about ADP. You know, it's an employment indicator, but it excludes the government hiring and firing. But I'm going to watch it more so this week because it's on Wednesday. And of course, the FOMC meeting is after that. So it's, you know, they're going to, because they're having their meeting before NFP comes out on Friday, they're going to be looking closer at the ADP number because they're going to use that as a little bit of a heads up of what they expect from NFP. Of course, they don't always match up perfectly. We've also got some PMIs and ISMs coming out from the US. But, you know, really, Friday is going to be the key one. after we get through the FOMC meeting. Inflation's not really dropping. Even if you see this drop in demand, or it's starting to feed into the data, you're seeing this little drop in demand, but prices aren't coming down. When it comes to the NFP, I'm much more interested in the earnings and hours that are worked for me, because that's inflationary data again. Coming on to the UK, again, we've got manufacturing data. And of course, we've got the Bank of England on Thursday with the MPC meeting. Now, this one's not quite so strong. This could be 50 or 75. Because UK politics has been in such a sort of chaotic state caused by the Tories recently. And of course, now Sunak and Hunt are now looking for this extra 50 billion, potential tax hikes coming, etc. It's going to drain from the system. So, the Bank of England might only do 50 instead of 75. The EU got some retail sales, a little bit of GDP, inflationary data there, a little bit of manufacturing. So again, just keep an eye on all that, because it is going to impact the euro. And then Japan, Bank of Japan minutes are due. So again, to sort of find out if there was anybody actually talking about bringing the rates even to zero, let alone positive. Or whether they, at the moment they just don't seem keen on it at all. Are they going to be proved right? Probably not. I mean, this cheap money's gone. It's not going to come back anytime soon. With Canada, we've got PMI and employment data coming out, and in China, manufacturing. They got lockdowns, but those lockdowns are increasing. So again, as you see going on to sort of the November, looking back at October data, and then in December looking back at November's data, there is potential for that manufacturing to drop just because of these lockdowns. And as I say, the lockdowns are becoming more rather than less. So inflation outlook. So, we've seen that those earnings were mixed with the tech stocks performing badly, wiping billions off of their company valuations. Now, but of course, we've got households that are struggling, and consumers will not be rushing to replace their phones or tablets, tech stuff basically, maybe even for the next couple of years. They'd rather just stick with the model they've got. Everyone has a must-have the new stuff out, but it's a matter of affordability, and at the moment that's dropping off. However, we are seeing banks, energy companies, supermarkets performing well. As I mentioned earlier, the dollar weakened. Investors and traders expect the Fed to slow down these rate rises. I'm just not sure they're right. Okay, we might see a drop in demand, but if we don't see an increase in supply, again, if we don't see inflation start to come down, then seriously, you expect the Fed to slow down or even stop these rate increases? Slow down possibly, maybe a little bit more of a wait and see as this, all the rises that they've done so far feed into the system. But personally, I think they've got more to go, and for longer. Supply issues are still there for sure. And China's increasing their lockdown. Apparently, it's around about 210 million people that are currently contained. Of course, Musk completed buying Twitter. That included a few exec sackings straight away, as I mentioned. But there's, a lot more staff that could disappear from there. This inflation is still the issue, though. It's not dropping as central banks were hoping by hiking rates. It's just not happening. And of course, that's a problem for them. But, it's understandable, because if it's coming from the supply side, then there's not much they can do about that. Inflation. So, yep, there was Germany. Again, that their inflation is still increasing. And US jobless is starting to creep up, so keep an eye on those as well. Now, with inflation remaining high, again, we just got to wait and see the data as it comes out, because it's, the central banks are becoming much more sort of reactive to the current data rather than necessarily just going forward with the strategic plan that they've created. They are willing to tweak that slightly if necessary, if possible. But until you see inflation dropping, I keep emphasising this. I don't think that they can. Even if they stop putting rates up, they're just going to hold them there. I really believe that, and for some time. So we've got stagflations and recessions around the corner. How fast they're going to reach us is going to be different depending on the country, etc. But they're coming, because with these rates up, people can't, household bills, food, energy, there's all these pressures on households, for their spending. Okay, the US are in a bit more of a stronger position because all that stimulus that was done over COVID, that's given US households a bit of a cushion. But, that's a luxury that most of the rest of the world doesn't enjoy. And of course, these supply chains could get worse again because of the Chinese lockdowns. Midterm elections, as I mentioned, are on the 8th of November. And again, that's Biden's desperate to sort of, obviously, to win those or keep control of the houses. But I would say that's on a knife edge at the moment. The consumers, okay, they've seen gasoline prices come down a bit, but what they're not seeing are food prices come down. They're not really seeing any benefits at the moment. And, all they're going to see is that the money that they had saved is starting to be eaten away by inflation. Russia, Ukraine, still ongoing. I think it's the 9-month now. So, just doesn't seem to be in the end to that. Russia have been using more drones to attack because Ukraine has been making more and more ground towards recapturing lost sort of ground. As I mentioned, energy and food inflation is just continuing. You would expect it to be a bit lower because, as far as I'm concerned, food prices and energy prices have dropped. I mean, if you look at oil now, it's sort of mid-80s. It was up to 130 after everyone panicked from the Russian invasion. Food prices, they went well up as well, massively up. But they've come back as well. And then you've got Europe now that's at the moment, they're in quite a good position with their gas because the weather in Europe has been quite timid for this time of year, quite warm even. And of course, that's put less of a drain on the gas supplies. They've managed to sort of rebuild them out. But as I said, Germany still got that inflation increasing. I think part of that was because they removed the travel subsidy that they'd put in. I think it was about €9 and you could pretty much travel anywhere. FOMC, we're going to see that 75 basis points. Anything other than that is going to be a massive surprise to the market. But of course, listen to what is said and the press conference after as well, because they're going to be very important. They didn't start their rate rises until at the beginning of May. And yet, they've been trying to play catch up and now they've really leapt ahead of most. But those energy and food prices, for me, wholesale prices have come down. They're much more realistic. For me, all I can believe is they're almost close to where they were sort of pre-Russia's invasion of Ukraine. Gas obviously a bit higher still. Oil still a bit higher, but overall, nowhere to where they were. and of course those reserves have increased. Funny, I just on the sort of the metaverse, just want to mention something on there before I carry on with all this. It seems that Hollywood's now favouring Roblox, ROBLOX, that is, for all the stuff that they're posting in the metaverse. So that's interesting. Okay, getting back to this, just want to mention that because I'm a bit of a fan of the metaverse. Supply chain issues still there. China lockdowns, 210 million lockdown. That could still continue to increase. It's going to make it more difficult. So that again could dampen supply chains. Russia's invasion of Ukraine continuing. As I say, we've got the energy and food inflation, lack of workers. Earnings pressures are still there. Although I expect a lot of these jobs to start disappearing. I mean, jobless claims is slowly, quietly increasing in the US. And of course, we've got this US-China sort of decoupling, it's called, where Biden's trying to slow down China's sort of tech advancements. He's restricting some of the technology that's available to them to try and delay their advances in tech. Of course, that's okay, but you're only going to keep them for so long, and then they're probably going to motor ahead anyway. All right, so now we've sort of looked at that. Let's